Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site, we have Marina Severinovsky, Head of Sustainability of North America at Schroders, Sharo Atmeh, co-founder and COO of Montauk Climate, as well as joining us remotely, Rebecca Fitz, founding member of the Center of Energy Impact at BCG. We're here to discuss financing the clean energy transition and why we're at a turning point in the clean technology markets. It is great to have everyone with us in studio, and Rebecca joining us from DC. Marina, let's kick it off where we are right now with the energy transition in 2025. It feels as if there's some fundamental challenges and uncertainty out there.
Well, yes, certainly I think policy uncertainty is sort of one of those. I mean, I think our feeling is that we have to kind of think long term. What is driving energy transition, this sort of need to change how we sort of use energy over time, isn't going away. And I think big institutional investors like us and kind of clients of ours are also on a single sort of track, in the sense that we've got globally sort of net zero commitments covering now kind of 80–90% of global GDP. We've got a lot of corporations making those same commitments, and investors kind of working their way towards, you know, it's many years out, but kind of those net zero ambitions. So I think a lot of those fundamental drivers of that long-term energy transition continue to be there. And then, you know, I can speak to, and I'm sure in some of the follow-up conversation, you know, we invest both from a public markets perspective and also a private markets perspective through our Green Coat business, which is sustainable infrastructure, energy, you know, wind and solar. And we see a lot of opportunity on both sides, despite, you know, some of, again, the policy uncertainty, just on the basis of valuations, frankly, and kind of how we can see earnings evolving. So I'm sure we'll follow up on that.
And we certainly will. And Sharo, you mentioned in your notes that we're at a turning point when it comes to the clean tech markets, where we were, let's call it 30 years ago. A couple questions here. Tell us why you think that is, and then do you think some of these targets are too aggressive? A lot of them are for 2030, and we're, let's do the math here, you know, we're not that far away.
Well, we are certainly at a turning point in the electricity markets in the United States and the energy markets in the US, in large part because now we have the ability to turn electrons into intelligence with the power of AI. And so whereas for the last 30 years, electricity growth was roughly balanced out by efficiency gains to make electricity growth less than the rate of GDP. But now electricity growth is growing at nearly double the rate of GDP. And so what's happening is a huge demand pull for electrons, and more energy needs to be used every single day. And that electron economy will continue to expand as human beings change their preferences from molecules to electrons, but also to electric vehicles, to AI data center growth, to load growth all over the country for all sorts of different reasons.
Yeah, and Rebecca, I'd love to bring you into the conversation here, because you have noted as well, BCG Center for Energy Impact, there is a bridge for that capital gap that needs to be made. I mean, these are capital intensive projects to meet quite aggressive goals in 2030.
Yeah, I think the energy sector is among the most capital intensive sector in the global economy. And one of the things we've looked at and we work with clients on is how to allocate capital to both satisfy shareholders and accelerate green spending commitments. One of the tensions we're seeing today in the global energy sector is, at times, investment in low carbon technologies may be at odds with maximizing earnings and maximizing returns. And it's an interesting dynamic, working with and seeing how companies reconcile those differing ambitions to get where they want to be by 2030. And certainly this comment was brought up earlier, but there's a critical role for private investment in essentially allocating a different valuation to some of the renewable technologies, renewable investments that are desperately needed in an increasing power demand outlook. And how do you, private capital may tend to see a higher valuation, a higher value to those assets than publicly traded companies can today.
Yeah, and Rebecca, I think part of the challenge is too, there is a need for global policymakers to come together and have a cohesive strategy and regulatory framework around that. I'm not quite sure that's entirely attainable. I mean, you're looking at multiple jurisdictions, not only in the US, but if you operate globally, which many of these, you know, energy conglomerates do. And then there's so many different types of technologies that are within the climate space. I think, you know, know if I'd call it restructuring, but it feels as if it's disjointed when we think about all these technologies, all these priorities, but there isn't a cohesive framework around it.
Yeah, and I think from a company actor point of view, there are limitations to what can be done to encourage global action, and perhaps global action may need to be outside the ambition of company, both publicly and privately traded investors. But one of the things I hear a lot is that energy sector investors invest for the long term, much longer term than maybe a single administration, single policy perspective. And so how do you develop, sanction, move forward projects that are durable across varying jurisdictions, administrations? And what that tends to point to is a measure of conservatism in spending and, a deep focus on project economics so that can weather varying changes in the external environment.
Yeah, and Marina, you had noticed this year that you're starting, investors are increasingly calling on policymakers for a number of things. How are investors approaching it when they think about policy framework?
Yeah, I mean, we saw this, I think, even kind of last year. I would say in the fall, a lot of the events that we were attending, just this acknowledgement that we as investors can't drive the policy agenda alone. Like, we need to move capital to these places, right? To further, again, kind of energy transition, but that you need that policy support, and that it has to actually link together climate change, nature loss, even things like social inequality. And you have to think about this kind of increasingly defining the global economic outlook, the business agenda, the investment landscape. So I think the greater push, as you say, is for kind of industry collaborating with regulators in the private sector, more challenging given what's going on in the US, but you have kind of Europe, you have Japan, China, India. Some of the policy direction is similar in terms of establishing policies at an industry and sector level to support transition, to unlock private investment, to integrate, I think, nature into like national government targets and sector transition plans, and to have clearer adaptation plans also to address climate change and nature loss. And so that creation of both incentives and then transparency around that, I think, being really critical. So we've actually written kind of a policy piece where we talk about kind of, here are the details. This is what we would like from policymakers. It's a wish list. You're not going to get everything that you want. But I think, as we said, kind of you have that long-term perspective over the longer run, outside of where we are today with the current administration in the US, you do have that policy direction on a global basis.
Yeah, I mean, it sounds like the only way that this will be executed is by public-private partnerships. Yeah. And even when you think about incorporating utilities into it and the policy framework to make that happen, I don't think there's any other way.
Totally. The private markets are going to have to step in, and they usually do when government policy begins to pull back, and private markets need to show that they mean it with their dollars and where they're actually expending CapEx. We just learned this morning that of all the electrons added to the grid in the last quarter, over 80% of them were either wind or solar, which is an amazing accomplishment for the United States. But we can see that the private market is already beginning to order these clean tech solutions in place. And the policy environment being supportive is great, but the private market is moving forward, and we are generating efficient innovations on this. And our whole job at Montauk Climate is to create those efficient innovations.
Yeah, well, Marina, what's interesting with these types of investments, they are, one, capital intensive, but they can also be locked up for a while, right? I mean, it takes time to get any sort of energy source online. So when you're thinking about this from an investing point of view, how are you thinking about extrapolating that value and still having a longer term mindset?
Yeah, I mean, this has been, obviously, there's been a number of sort of fits and starts in recent years. So I've got to, let's say, focus on the kind of the public market side. We just see, again, sort of a 20% discount between the kind of global alternative energy index and the MSCI ACWI. I mean, even if it's public markets, we do invest for the long term there as well. At the same time, we see 2-year forward growth expectations that are 5 or 6 times higher. So there's just a significant disconnect, right? On the private market side, again, I think what we kind of line up, for ourselves in terms of, we're looking at some of the detractors, right? Kind of higher tariffs, for example, some of the obviously kind of changes in policy. But in general, like we know that campaign rhetoric doesn't translate directly into federal action. We don't want to prematurely rule out the IRA, given just a lot of the benefit has accrued to sort of Republican states, or even sort of, like more rural areas within kind of left-leaning states, right, that do tend to send Republicans to Congress. And so some of those benefits are still there. And then I think the cost considerations, like that's kind of a big thing, is you're leaning on kind of the private market to say, you know, companies have commitments to sustainability that's going to continue to drive their demand for clean energy. It's just a longer term perspective, and then how cost competitive, as you noted, right? Kind of, you know, wind and solar are becoming over time, and then the massive demand, especially around AI. And so all of those factors just kind of conflating to a point where as a long-term investor, you feel like, you know, the trends will be in that direction. And if you have that horizon, you know, you'll be able to play that out.
So Rebecca, let's talk about this for a moment here, financing the energy transition. Where is it coming up short, and what are some potential solutions that could be applied?
Well, I mean, when we look across the, you know, the whole suite of energy transition investments, one of the primary areas we've seen it fall short is in end user investments. And I think the concept of public-private investment is very important in this area. So end user investments are actually investments that reside, for the most part, outside the energy sector. So we can look across energy companies, both public and private, and see mobilization of investment that largely addresses like decarbonization of fossil fuels or advancement in renewable technologies. But those end user investments, for instance, how to decarbonize a steel plant, which is an industrial goods type of investment that would largely not be captured in energy sector spending, is a big gap today. And so one of the ways we've thought about it is there are different operating models that go into heavy industry that could be considered. Significant change potentially in business models, but nevertheless, we've seen case studies of success. There's also, I mean, a lot of the public-private engagement could be around subsidization of the consumer and what they're paying for. That's not without challenges, and they've already been spoken to. Like the visibility on the future of subsidization to decarbonize is rather uncertain at this moment. Nevertheless, those targeted engagements to help stimulate consumer or large industrial goods spending towards decarbonization remains a gap as we see it.
Yeah. Well, Rebecca, what are your thoughts on, you know, M&A or divestitures, or what about accomplishing this through different types of partnerships?
Yeah, so when we look at the energy M&A space, I mean, I think it's a critical tool to transforming portfolios and doing it in a way that both stewards the financial structure and enables portfolio transformation. And I think, you know, for example, over the last 2 years, we've seen a lot of oil and gas sector M&A designed to high-grade portfolios, shore up the financial structure. One of the things that becomes interesting when we think about, you know, what other M&A to anticipate in the energy sector to get portfolios and financial structures fit for purpose is some of the power and utility sector. For example, you know, we've already spoken about huge demand growth expectations in the sector tied to data center demand growth. And ultimately, that's a huge CapEx challenge. And M&A and right-sizing the portfolio, so diversification, you know, removing some of the diversification, moving towards portfolio simplification and taking proceeds to channel it to the type of growth that's needed is absolutely a lever for portfolio fortification and financial fortification.
All right, thanks, Rebecca. And Sharo, I think it's important to note as well, it's urgent that the U.S. accelerate and innovate in this area, because it's also a matter of national security, whether we're procuring the elements and the commodities that go into advancing, you know, our climate tech priorities, but it really does come down to national security as well.
Totally, regardless of the individual small policies that change, whether to subsidize this or change that, it is of the utmost urgency that the U.S. accelerate and innovate in the amount of energy we can deliver cleanly and quickly, because as we said before, we can now turn electrons into intelligence. And China has the ability to build out power very quickly, much more quickly than the United States at this point. But as a matter of national security, we must win the energy race and we must win the AI race.
Yeah, and I see you shaking your head over there, Marina, because you noted that as well. China is also a big supplier of many of these components that are part of this energy transition.
Yeah, I'm not sure if there's a question
no,
there, but
just to follow up on
definitely. No, I think the other point that I was going to make in terms of like where we sort of see the opportunity in transitioning companies, again, for our institutional client base is sort of twofold. It's companies transitioning their own business models to, kind of a cleaner source, right? And so that's on the demand side, right? They're shifting their demand and they're being rewarded. Companies that are becoming less carbon intensive in their operations over the last 5 years have been outperforming those who are not moving at that same speed. We see no reason why that would change. And then there's companies that are kind of providing the goods and services for others to decarbonize. And so you see over time the demand for those goods and services going up. And so, what we find is while some investors certainly are interested in decarbonization, for that sake, right? We want to decarbonize a portfolio. Actually, we have in the US, we've had kind of institutional investors saying 77% are already investing in clean energy or they're intending to in the next couple of years. And their primary sort of objective is actually diversification of portfolios and returns. And then decarbonization is only kind of the third consideration. That's for the US, it's different in Europe, right? And so I think it's just kind of this acknowledgement that this is moving forward. There's a couple of other sort of points that I would make is that, we see companies kind of not abandoning their commitment to their stakeholders. That could be employees, customers, their shareholders, not just in the US, but abroad, who have different expectations of them. So they're trying to kind of make their operations more sustainable. And then the last point, I think we were talking about kind of the end user, but companies becoming more direct purchasers of power from suppliers, actually bypassing intermediaries like utility companies. And so that trend would support, I think, demand for clean energy, especially as it becomes more and more economic.
Yeah, and Sharo, that's part of it too, right? It needs to be available at scale. It needs to be affordable, particularly when you think about the consumer, because you just won't get the buy-in there. Speaking of buy-in, though, if we look at Trump 1.0, he really benched himself against the markets, the economy, and it appears to be that 2.0 is certainly going to be the same way. Do you think, and we touched on this before as it relates to M&A, he wants to be a leader as it relates to innovation. Do you think the M&A environment from a regulatory perspective might be a little bit more friendly than it was the first time around?
I think we're seeing some headlines on this front this morning in the news. Look, very large funds are beginning to gear up to look at and start to acquire clean energy because margins are very strong in clean energy, and most importantly, as we talked about, very long-term contracts are involved in clean energy. So who wouldn't want to acquire something that is 25 years worth of revenue streams at an extremely profitable rate? Of course. The Trump administration has shown initially that it's going to be friendly to M&A activity, and I think the clean energy market is pretty fragmented, and I imagine that there's not going to be much pushback. Of course, the Trump administration was the one that challenged the big mega mergers, Time Warner, AT&T, Time Warner, but I don't think, at least from our perspective, that there's going to be very much M&A.
But see, that's different though. AT&T, Time Warner, it's different than when you're talking about being the leaders in innovation and winning when it comes to national security. I think those are two different things. But to your point, it is so fragmented, right? And it's not, in the semiconductor space, you have chips and there's subtleties there that's different, but there's thousands of technologies that are going into this energy transition.
Right. And they're only going to be more because as the clean energy system goes from a centralized power grid to a decentralized power grid, that's sort of the point. You create resilience through your decentralization. But the market right now really needs central nervous system solutions and really needs M&A to help us get there. And it really needs people to innovate and create technologies that are going to become the core central nervous system of all of these distributed pieces of technology. The utilities, of which there are 3,000 in the United States, I think people underappreciate that, are out there buying this technology on a distributed basis, but
sounds like
really,
you're talking about blockchain there for a moment.
Well, the new energy system and blockchain do have a lot in common, including energy use, but there's a world where you see M&A actually beginning to create more efficient, even more efficient energy systems so that we can begin to make back up the efficiency gains that we're seeing decline today with the rise of data centers.
And one more point?
Well, yeah, I was going to say, I think around that issue of kind of energy independence, energy security, energy dominance, right? I think it's like, it seems to me that the message is kind of all of the above. There's a few areas like offshore wind, for example, that have sort of attracted some ire, right? So, but even that is a very small proportion of sort of wind development, and lots of other technologies, right? So whether it's nuclear or like hydrocarbon, like there's many areas where I think there could be support to say if these things are all driving us forward, like it's letting the market preference what is more economic, but letting it run, right, rather than sort of putting up roadblocks, and certainly less regulation overall, can be I think a boost both on the across the energy spectrum.
All right, appreciate both of your insights, and Rebecca as well. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.